Good morning and welcome to today's Premium Account Short Form Market Update for the 12th of March. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material from their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Investor Signals. I have over 17 years of experience in the financial services industry as a licensed securities and derivatives advisor. The format for today's presentation is a short form update, so a quick review of the macro update. We look at the ASX top 50 with a particular focus on stocks with their earnings review into financial year 15, and we conclude with a summary of some of our recent transactions and short-term market outlook. Investor Signals Premium Account Service is focused around a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns, and a big part of that investment strategy is the effective ownership around ex-dividend dates, which should produce above average cash flow while still providing for capital growth. The investment process is under a strict investment mandate, therefore suitable for self-managed super funds, and importantly all the assets remain in your name. For further information around Investor Signals Premium Account, please contact me, Leon, at investorsignals.com. Moving straight into a graph of the Dow Jones in the US at the moment. Now, from a valuation standpoint, S&P 500 is currently delivering around $110 on average of earnings per share, which if you apply a standard multiple of somewhere around 14 to 15 times earnings, that sort of creates fair value for the broader Dow Jones index back at around 14,500 points. Effectively, what the market's telling us at the moment is the market's willing to pay for roughly 8 to 10% forward earnings growth in the US, and on that basis, fair value takes it back to around 16,000 points. We're starting to see the early signs of sort of some lower expectations for growth out of the emerging markets, albeit that's being balanced by slightly better data coming through, the early part of better data coming through out of Europe, which feeds into our base case that I think markets really large move sideways over the next 6 months. We get into a period of consolidation, and it's only until we get sort of more synchronized global GDP growth picking up, which will come from an improving Europe and a stabilizing emerging markets, that we have any chance of equities pushing higher. I think the result of equities moving higher, in part driven by bond yields moving lower, I think that's really played out to almost the maximum extent it can do, and we'll see that particularly reflected in some of the names in the ASX top 50 when we look at examples of, say, Woolworths and Wesfarmers from a valuation standpoint. So again, yes, the US market may deliver 8% earnings growth in the next 12 months. Downside risk is it essentially stays at or near current earnings run rate, in which there could be 10% sort of downside risk. But I think if you take a slightly longer term perspective and just say across the next 6 months, the most probable outcome is that the markets consolidate, and then we get into maybe a further trend higher in the latter part of the year. Let's just quickly look at the 10-year treasuries in the US. This is always a good benchmark as to where the bond market sees a global growth heading. We've seen bond yields come back from around 3% at the top end there, back down to 2.5%. They're now trading back up around 2.7%. Again, our base case that equities move sideways requires this bond market to really consolidate between these levels, and I think at the moment at around 2.7, essentially we're not getting any alarming signals there out of the bond market that equity markets are substantially overvalued. So from a domestic standpoint, our market's pricing in roughly around 15 times PE, and looking for earnings growth somewhere around that 8 to 10% as well out of our market. Now, a big part of that has to come from the resource sector. A lot of the, I suppose, growth in the industrial stocks, given their current valuations, I think is going to be fairly muted. But on screen here you can see that we're largely allowing for the local equity market to pull back to around sort of 5,200. I think we consolidate, and consistent with that sort of macro view in the US there, that we get into a period of 6 months of consolidation and possibly a push higher after that. On that note, let's go straight into a couple of stocks within the top 50 that we're focused on at the moment. So AGK, we look out into 2015, the company needs to deliver around 5 to 8% earnings growth. That'll put the stock on about 13 times earnings and about a 4.7% dividend yield. I think on any sell-off here, the stock becomes interesting again. I think sort of on a 12 to 24 month outlook for AGK, there's certainly some value there. Amcor, into 2015, if the company delivers somewhere around 8 to 10% earnings growth, looking for around 75 cents of earnings per share, the company's forecast to pay out about 51 cents of that in the form of a dividend. That'll put it on a yield of around 5% based on FY 15 earnings, and it puts it on a PE of around 13 times. Now, to put this into context, obviously we're most of the way through FY 14 now, and the focus does become which companies are likely to deliver consistent growth over the next couple of years, as that's where we're going to find value in the market. If we go out to financial year 16 and Amcor can continue to deliver sort of 5 to 8% earnings growth, we start to sort of get back down to a 12 times PE and the dividend yield creeping back up to around 5.5%. So on any sell-off here in Amcor, we see this as a reasonable value and defensive play. So we're buyers of the stock at this level. Short term, across the next 6 to 12 months, it's hard to build a case that the stock can trade much back above 11.25. So where we are buyers of it on the dip, we're certainly looking to sell those covered calls. And a combination of that call premium and the dividend income again drives in excess of 10% cash flow out of Amcor and providing the opportunity for some capital growth. Another name that we'll have a quick look at in today's recording is the ASX. Now, from 2014 to 2015, the company should deliver somewhere close to 8 to 10% earnings growth. If it does that, the PE drops from current levels, which is around 19 times, which is quite expensive, and on current prices, the stock's on about a 4.8% dividend yield. So if the company does deliver the 10% earnings growth into financial year 15, the PE sort of drops back down to around 17 times. If that earnings growth was to continue into FY 16, that PE drops back down to around 15, which is starting to get back to sort of the long run average. Again, the distortion in these PE valuations is a result of the very low bond yields, which I've been spending a lot of time chatting about over the last year or so in the recordings. So from here, what's important for ASX is I think the downside risk to its earnings seems reasonably limited. I think the prospect of the company delivering 5 to 10% earnings growth is a real probability, and in that environment we're collecting around a 5% dividend yield. So again, on any sell-off here, we're buyers of ASX, and we're looking to sell the covered calls up at around $37, $38 over ASX. I don't sort of see too much upside. And so to the extent that clients have been buying it in the last few days, we've been selling the calls at around the $38 level out to December. We're collecting around $1 premium for those. So again, combine that with sort of the upcoming dividend in the August-September period and the call premium, we're effectively getting an exit price back up around $40, and I just don't think the earnings outlook supports a valuation too much beyond that. So again, we're looking for these defensive names where we think the earnings will sort of remain reasonably robust with some growth, and a combination of the dividend call premium starts to drive a return of around 10 or 12%, even in an environment where the market moves sideways. BHP, so the big news in the market over the last few days has been the shift in iron ore prices. So if you go back 3 months ago, iron ore was trading at 140 a tonne. We're now back down at 110 a tonne. So that has a substantial impact for the forward earnings outlook for BHP and Rio. Whereas these iron ore companies were substantial contributors to the earnings growth in the first half of 2014 earning results, and a lot of upgrades started to come through on the assumption that they'll deliver something in the order of around 10% earnings growth in the 12 months ahead. If spot iron ore prices were to stay where they are, we'd actually see downgrades to BHP and Rio somewhere in the order of 5 to 10% from first half 14. So from a valuation standpoint, what that means is BHP's trading about 12 times current earnings on about a 3.5% dividend yield. I think the probability of the company providing a capital return into the back half of this year, I think sort of somewhere around this $35 level, BHP finds support. We've purposely avoided the pure iron ore plays with Rio and Fortescue. I think the petroleum exposure or energy exposure in BHP's asset portfolio makes it slightly more defensive. So we're happy again for capital that's being freed up to start to look at it at these levels. We largely sold the covered calls when the stock was up at this level at around $39. We collected the dividend, we collected that call premium. I had been sort of suggesting in the prior week's recordings that the resource stocks are really getting sort of at the top end of their range, and we're not looking for any more growth out of them, and hence we started to cap those covered calls. Moving on from BHP, quick look at Computershare. So this is a name that I'm concerned is a little bit expensive. So we've delivered the stock, we've taken the profit, and we probably don't revisit Computershare again until it gets back down into that sort of $10.50 range. And just to put some numbers on it, the stock's trading 19 times current earnings on a 2.6% dividend yield. The earnings growth is really probably not too much more than about 5 or 8% out of Computershare. The company would have to continue to grow at about 10% just to support next year's valuations at around 17 times earnings. So you're already paying up today for that 10% earnings growth. I just think Computershare is looking a bit expensive up here at these levels. Lendlease. So Lendlease, on the other hand, this is a name that we like. So as capital's freed up in client portfolios, we continue to look at Lendlease. The company delivered a reasonably uninspiring earnings result, but again, management's provided fairly bullish forecasts over the next 2 or 3 years, and I think Lendlease is in the right sort of space to benefit from some of the stimulus measures or the RBA's focus of sort of driving construction, both domestically and then at a global level, obviously the developing property market and infrastructure opportunities. So from Lendlease's perspective, they delivered 92 cents of earnings per share, paid out about 42 cents of that in 14, puts the stock on about a 3.75% dividend yield. We're looking for around 10% earnings growth into 2015, puts the stock at 11 times earnings on a 4% dividend yield. But I think the story here for Lendlease is they can deliver sort of back-to-back high single-digit earnings growth over the next 2 or 3 years. So we own it at lower levels. We're selling the covered call at $12. We've collected the recent dividend. But even on any pullback back down to around $11, I think it's a good buying opportunity. So we continue to look to keep exposure there to Lendlease. Having a quick look at Macquarie. So this is another one of those examples where I think it's starting to look a little bit expensive. The market's pricing in 20% earnings growth into 2015, puts the stock on 15 times earnings and a 5% dividend yield. However, if they don't deliver that 20% earnings growth, what you're looking at is a stock that's trading 18 times earnings and on a 4% dividend yield. And I think you've got better value elsewhere in the market. So for my money, I'm starting to think Macquarie's looking a little bit expensive up at these levels. Origin, put some numbers around this. The stock's trading 20 times current earnings, and I've highlighted at $15 it's expensive, so we've been selling the covered calls. On a 3.5% dividend yield, the company delivered very little earnings growth in the last 12 months, and looking forward over the next 12 months, the market's reasonably optimistic that the company's going to deliver close to 10% earnings growth. So at $15 a share, it's been priced at 17 times earnings and 3.5% dividend yield. I think it's not until we get another 12 months down the track that we really start to see the earnings uplift come through for Origin. So my preference is to sell reasonably tight covered calls over Origin. AZJ, just to take a quick look at this name. So here's one that we own at lower levels, delivering consistently good earnings result. If we look out into 2015, the market's looking for around 20% earnings growth out of AZJ. I don't think they're going to deliver that. I think if we work on the assumption that they deliver about 10% earnings growth, still puts the stock on 20 times earnings and around a 3.5% dividend yield. So consequently, we own it at lower levels. We sold the covered calls when the stock was at 525. We've capped it out at 550. I think the range is sort of 490 to 550. Instead of sort of owning the stock and getting a 3% dividend yield, we're driving around 10 or 12% cash flow out of AZJ. Stocklands, just to look at a property stock as an example, I've spent a lot of time chatting about Stocklands paying out all of their earnings in dividends, which is nothing wrong with that, but the prospect of any sort of significant dividend increase is obviously now a direct factor of the underlying earnings growth of the business. On a forward 12-month outlook into, say, 2015, the company should deliver about an extra 8 to 10% of earnings growth. Keeps the stock on around a 6% dividend yield, trades 15 times earnings, and that supports my case that the stock was value down here. As it gets up to around $4, we need to look to be selling the covered calls, and that'll sort of complement that cash flow from 6% up to around 10 or 12%. I think from here, the stock, it's hard going to justify a valuation much above $4. A quick look at Telstra. So really from Telstra's standpoint, the stock's trading at about a 6% dividend yield, delivering somewhere in the order of maybe 3 to 5% earnings growth. We've seen the dividend tick up from 28 cents to 29 cents. Maybe we'll see it push up to 30 cents in 2015. I think Telstra can support a valuation back up around 5.25, and therefore we're buyers of it on the dip at or near this level. A few more to go. Toll Holdings, to have a quick look at this name. They delivered a fairly flat earnings result in 14. The stock trades 13 times earnings on a 5.5% dividend yield. Into 2015, we're not looking for much in the way of earnings growth. Therefore, to the extent that we have exposure to it at or near these levels, we're trying to sell the covered calls up at around 5.75. I don't see the impetus for an earnings uptick or yield compression to drive a share price much beyond that level in Toll. WDC, continue to like this name. To put some numbers around this, the company delivered around 68 cents of earnings per share, paid out 52 cents in 14. Puts it on a 5% dividend yield, 15 times earnings. I think the company can deliver somewhere in the order of 5% earnings growth into 2015, and therefore it could support a valuation back up at around $11, but we're certainly keen to sell the covered calls up at around $11.30 to $11.50. I don't see too much upside. That would put the stock back on sort of something less than a 5% dividend yield, around 4.75, and I think versus the other property plays and relative to its earnings growth, I don't see too much upside from there. Final two stocks to go today, Wesfarmers. So to put some numbers on this, on the current earnings, Wesfarmers trades almost 20 times earnings on a 4.5% dividend yield. I think if we were to form a view that the company consistently can deliver somewhere around 8 to 10% earnings growth, the short-term valuation of it, albeit expensive, starts to look more attractive if we go out to, say, 2015, 2016. So to have a look at it out in financial year 16, it puts a stock on 16 times earnings and a 5.5% dividend yield. So again, to put that into context, we're paying today for almost 2 years of earnings growth in Wesfarmers, and it's only then that we're paying a valuation that is consistent with sort of the historical sort of trend of Wesfarmers trading around 15, 16 times earnings. The reason why these valuations again are pushed up at such high levels is because the bond yields are down so low. So it needs to be considered in a relative sense. I think Wesfarmers still makes sense to own it at these levels, but again, because of this valuation issue, we need to be selling fairly tight covered calls. We're selling calls at around the $44.50 level, again turning this sort of 4.5% dividend yield into something in the order of 10 or 12% return and providing for some capital growth. Woolworths, let's have a quick look at that as the final one to finish on. So Woolworths up here, when you look at the current valuations, is 19 times earnings on a 3.8% dividend yield. Woolworths pays their dividend next week around 65 cents. I think post that, fair valuation for Woolworths is back at around $35. If we go out and assume that Woolworths continues to deliver 10% earnings growth, or it won't be that high, mate, around 6% earnings growth in a financial year 15, it puts the stock on 17 times FY 15 earnings and a 4% dividend yield. So even if we go out to financial year 16 and continue to see this 6% earnings growth, the stock's only on a 4.4% dividend yield and 16 times earnings. So all of this, and the point of today's discussion, is to really sort of feed into this view, and I'll just bring the XJO back up again, is that a lot of the industrial and defensive names are quite expensive from a historical PE standpoint. Therefore, I don't think you're likely to see the same type of capital growth in these names that we've enjoyed over the last couple of years. And I think that sets up for a fairly compelling environment to be writing covered calls over these names without having an overweight position to resources and banking stocks in portfolios. So I'm comfortable that generally speaking that we can drive sort of somewhere in the order of 10 to 12% cash flow out of the bulk of the stocks that we're exposed to, continue to identify value in some of the names such as Amcor, Lendlease. Look at sort of the banking stocks as an area where there's probably a little more headroom from current levels. Some of the names like Computershare and Macquarie are getting a little bit expensive for my liking. Maybe the resources on this current sell-off, BHP, will provide an opportunity, but otherwise our strategy of being exposed to BHP and Woodside and avoiding sort of Rio and avoiding Fortescue has certainly played out right. So to summarise sort of where we see the market heading, possibly a little bit of weakness short term, but broadly our view is that the market consolidates and moves sideways, and we actually do get an environment where Europe starts to contribute more to global GDP and we get a stabilisation in the emerging markets. And I think as we get into the back half of this year and into 2015, we're probably likely to see another push higher in equity valuations off the back of sort of 8 to 10% underlying earnings growth in both the US and the Australian market. Thank you for listening in, and I look forward to speaking again next week.